What is up everyone? Today I'll be talking about stocks to watch out for in the month of November. So I realized that not everyone enjoys going through charts and graphs as much as I do, but I do know something that everyone likes: money. So I'm going to be talking about companies that are making lots of money, or if they're not currently making lots of money at the moment, companies that are poised for a bounce back to make lots of money in the future. First up, we have Activision Blizzard with the symbol AVTI. Now, they're mostly well known for the Call of Duty games. Also with Blizzard, there's StarCraft, World of Warcraft, and the Diablo franchise. Now, I used to think that Blizzard was an amazing company. Now, they used to be the industry standard when it comes to making high quality games. Now, here's a trivia for you. Do you know what was the first game that Blizzard made? It was actually the small pixel game called The Lost Vikings. It's actually a pretty decent game where you control 3 Vikings through space and trying to get off a spaceship. I used to also play a ton of Diablo 1, 2, and 3 back in the day until they brought up the real money auction house, which absolutely wrecked the in-game economy. Effectively, playing the game became a task of how much gold you can save up just to buy the next shiny piece of gear so you can progress further in difficulty. Playing the game literally became a job, which I absolutely hated. The main problem with Activision Blizzard is that they make pretty decent games but have absolutely terrible monetization system for the consumers. For example, in Overwatch, in-game skins and cosmetics for one Overwatch characters can now cost around $30 to $40 US, which is absolutely too much for something that's supposed to be free to play. Let's now talk about mobile games. The progression system in mobile game Diablo Immortals basically requires you to shell out large amounts of money in order to get new gems to upgrade your gear. Kiwi streamer Quinn69 spent more than 10,000 New Zealand dollars and didn't even get a single 5-star gem. When he finally gets the gem after spending more than 25,000 New Zealand dollars, he'll delete his account in protest. So why even pay attention to this company? Like I said, they have an almost predatory monetization system, but I guess because of that, they are a company that actually makes a lot of money. Their latest earnings report beat on projected earnings per shares and also revenue, mostly due to strong sales in the new Modern Warfare 2 and their mobile gaming division. But the main news with Activision Blizzard is that earlier in the year, Microsoft announced that they are planning on acquiring Activision potentially around June of 2023 at around $95 per share. In its own statement, Activision Blizzard confirmed that Microsoft would pay $95 per share to acquire Activision Blizzard for a total payout of $68.7 billion if the deal goes through. Usually when a bigger company acquires a smaller company, they tend to pay a premium to the current share price. The current share price for Activision Blizzard is around $72 per share, and you're looking at around a 33% upside if the deal eventually goes through. So this may potentially be a good time to pick up some Activision Blizzard stocks. Next up, we have Nvidia with the symbol NVDA. Even though I am primarily an AMD user, I still love Nvidia as a company, and Nvidia has been a long staple in my personal portfolio. Now, I bought in when they were around $220 per share, and now they're down to around $140 per share. But I'm still holding on because I think they will eventually recover. So Nvidia has suffered significantly from the crypto bear market. Now remember when crypto was all the craze? Yeah, that was only around 1 year ago. Now no one really talks about crypto that much anymore. Now the real reason why I think Nvidia still has a good long-term future is because of the Chips and Science Act that is passed in the US in October. The Biden administration aims to severely hobble China's chip industry with these new export rules. Basically, they are stopping the export of advanced semiconductor chips to Chinese companies due to potential national security concerns. This is extremely hilarious considering almost all the US teenagers use TikTok, which is of course owned by a Chinese company, ByteDance, and can be legally forced to share data with the Chinese government. Regardless, this may bring a direct conflict between China and the US when it comes to chip manufacturing. Nvidia even recently announced a slower chip for selling to China to avoid the US export ban. In the short term, I expect Nvidia stock to suffer from this new chips regulation. as they mentioned that export limitations could cost hundreds of millions of dollars in terms of revenue. But over the long term, I expect this to actually be a good thing for the company as they bring about more chip manufacturing back into the US. Currently, the share price for Nvidia is around $146 per share. But in the short term, I will probably expect the price to drop even lower before going higher in the future. The next company to take a look at is Walmart with the symbol WMT. Now, during the year of the lockdown of 2020, it seemed that online shopping was going to be the future forever. It's easy to imagine people just buying everything online from Amazon or China or some other place. Well, guess what? It turns out not to be the case. Most people actually genuinely like going to shop in physical stores. If we take a look at past earnings for the e-commerce giant Amazon, Amazon actually had negative profit margin quarter earnings already 2 times this year. Now, on the other hand, Walmart earnings has been steadily trending upwards. Now, this is reflected in the Amazon share price, where they had a steep decline earlier on this year when they missed their earnings projections. Earnings and revenue for Walmart have been steadily trending upwards over the past year. So this just proves that brick-and-mortar stores are definitely not dead yet. With the holiday seasons coming up, with Black Friday and Christmas looming, there could be a significant bump in terms of revenue for Walmart. The latest earnings report will be on the 15th of November. I will compare this stock to a packet of Doritos. You know what you're going to get. It's nothing particularly exciting. It's a blue chip stock that pretty much does the job. The final company that I want to take a look at this month is the Walt Disney Company with the symbol DIS. Now, Disney pretty much owns half of the movies and TV shows that we consume these days, and they include brands such as Pixar Animations, Marvel, and their 10 bajillion superhero movies. The problem with those movies and TV shows is that they all seem to be following a very similar narrative. Now, you have some virtuous main character that's out there saving the world, fighting some big CGI battles, and it all just ends up feeling pretty much the same, and it really starts to get old after the 20th movie of almost exactly the same thing. And then you have Lucasfilm with Star Wars and live sports with ESPN, and it's like Disney controls most of the media now. In their latest earnings report, Disney added 12 million subscribers to Disney+. This gives them a reported 235 million subscribers, which is around 10 million more than the 223 million subscribers that Netflix reported. So in just 3 years' time, Disney has overtaken Netflix as the most subscribed streaming platform. However, they also missed on analyst earnings and revenue targets, causing the share price to drop by around 8% to $92 per share in after-hours trading. So Disney has always been a very difficult company to predict. On one hand, they're such a massive company with so many well-known franchises that there's no reason why they wouldn't succeed. However, they might be bogged down by the fact that they are simply trying to do too much. Just look at the sheer number of shows that they're trying to pump out these days. You have Star Wars Mandalorian, Boba Fett, Kenobi, and Andor, and on the Marvel side, you have Hawkeye, Moon Knight, Ms. Marvel, She-Hulk. Honestly, there's just too many of them, and I don't really think anyone that has the time to watch all of them. And then on the movie side, you have Doctor Strange, Thor, the new Black Panther. It's just a lot. If we look at the share price chart for Disney, I mean, to be fair, Disney will be fine. Now, in the past, I bought Disney shares at around $100 per share in the past and sold them at around $130 per share for a small profit. Now, if their share price keeps on dropping, I will pick up some more shares and then sell them when they're a little bit higher. If we look at the share price for Disney itself, it's just been hovering around this region of around $100 for a very long time, and it had a spike right after the lockdown in 2021, and now it's dropped back down to around $100 per share. So overall, Disney is a massive company that is likely to see better performance in the future. So the 4 companies that I have marked down to watch out for includes Activision Blizzard, Nvidia, Walmart, and Disney. Special thanks to this video sponsor Tiger Brokers. If you are interested in purchasing any of these companies, you can easily do it in the Tiger Brokers app. It's one of the easiest to use broker applications out there with a ton of advanced charts and analysis features. Check out the link in the description to find a sign up code.